Margaret Chen spent 32 years in nursing administration at the Cleveland Clinic. She retired in June of 2023 at age 62. Her husband, Dennis, 65, was still earning as a part-time engineering consultant. They had what most planners would call a comfortable retirement starting position. Margaret made one timing decision that quietly cost her family approximately $35,000. 3 penalties stacked on top of one another. The Social Security earnings test withheld nearly her entire first year of benefits. The 85% taxability cliff locked in for life. And the IRMAA 2-year look-back drove her Medicare premium up the year she turned 65. None of the 3 looked connected. All of them traced back to one decision: the year she chose to claim. This is for informational purposes only and not financial, tax, or legal advice. Please consult a qualified Social Security claim specialist for your specific situation. My name is Robert, your guide to the retirement decisions that look ordinary on the surface and quietly punish you for years afterward. If this is helpful, hit subscribe. Drop your age and the year you are planning to claim in the comments. I will tell you which of the 3 traps applies to you. Today, I am going to walk you through the Social Security earnings test, what counts as wages, why severance is the silent trap inside it, and how it can wipe out your first year of benefits. I'm going to explain the 85% taxability cliff that has not been inflation adjusted since 1993. And I'm going to show you the IRMAA 2-year look-back, the rule that punishes you for one bad income year, and the 5-move framework that closes all 3 traps before you ever file. 3 penalties, 1 timing decision. By the end of this video, you will know all 3 by name. Trap Layer 1. The Social Security Earnings Test. Under United States Code Title 42, Section 403, if you claim Social Security before your full retirement age, the SSA applies an annual earnings test. For most workers born in 1960 or later, full retirement age is 67. Every year before 67, you have an earnings limit. In 2023, when Margaret claimed, that limit was $21,240. For 2025, it was $23,400. For 2026, SSA is expected to publish a limit of approximately $24,360. If your earnings exceed the limit while you are under full retirement age, Social Security withholds $1 for every $2 over. In the calendar year you actually reach full retirement age, only earnings before your FRA birthday count, and the reduction softens to 1 for every 3. After full retirement age, the earnings test disappears entirely. Margaret's 2023 looked like this: 6 months of base salary as a nursing supervisor, about $32,000. Then a $52,000 severance package in late June. Most retirees and most HR advisors believe severance does not count as wages because the employee is no longer working. The SSA disagrees. In Social Security's Program Operations Manual, Section RS 02505.240, severance is explicitly listed as wages for earnings test purposes if it is paid because of the employer-employee relationship. That includes virtually every severance package paid by a U.S. employer. Margaret's 2023 wages for the earnings test, about $84,000. Limit, $21,240. Amount over, $62,760. Withholding formula, $1 for every $2 over, so $31,380 in withholding. Her annual Social Security benefit at age 62 was approximately $19,200. SSA held back her entire 2023 benefit. She received 0 from Social Security in 2023. And because the withholding still exceeded what they owed her, they continued withholding into the first half of 2024. Many advisors will tell you not to worry. You get the withheld money back. That is partly true and mostly misleading. Under SSA's recomputation rule, the withheld months are factored in when you reach full retirement age. Your monthly check is adjusted upward to compensate. but there is no lump sum repayment. In present value terms, the dollars SSA held back from Margaret in her early 60s are gone. The SAFE rule. If you are under your full retirement age and you anticipate any taxable event in the year you plan to claim, severance, deferred comp, RSU vesting, a large Roth conversion, a business sale, do not claim that year. Wait for a clean year, or wait until full retirement age and the earnings test disappears entirely. Trap Layer 2. The 85% benefit taxability cliff. This is the rule that surprises retirees who think Social Security benefits are tax-free. They are not, for most American households. Under Internal Revenue Code Section 86, Social Security benefits become partially taxable above a series of provisional income thresholds. Provisional income is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. For joint filers, below $32,000 of provisional income, none of your benefits are taxed. Between $32,000 and $44,000, up to 50%. Above $44,000, up to 85%. For single filers, the thresholds drop to $25,000 and $34,000. Here is the part most people do not know. These thresholds were set in 1993 by the Omnibus Budget Reconciliation Act. Public Law 103-66. They have never been adjusted for inflation. In 1993, $44,000 was a comfortable middle-class income. In 2026, it is well below the median retirement household income. Virtually every retiree with any other income source, a pension, a part-time job, an IRA withdrawal, dividends, crosses the 85% threshold. Margaret's 2024 looked like this. Dennis's consulting, $58,000. Margaret's residual Social Security, $14,000. A 401k bridge withdrawal, $40,000. A Roth conversion her advisor had pre-scheduled, $90,000. Plus Dennis's deferred RSU vesting, $25,000. Combined 2024 modified adjusted gross income, approximately $227,000. Her provisional income was far above $44,000. 85% of every Social Security dollar she received became taxable at her 22% marginal rate. Federal tax on her benefits alone, that year, approximately $2,600. If she had waited until age 70, no earnings test, larger delayed retirement credits, and timed Roth conversions in clean years, her combined provisional income could have stayed below $32,000. Zero tax on her Social Security benefits. The 85% cliff is not just about how much you take from Social Security. It is about every other source of income in the same calendar year. Trap Layer 3. The IRMAA 2-year lookback. This is the rule that ties all three penalties together, and it is the rule almost no retiree anticipates because it punishes you 2 full years after the decision. Under Code of Federal Regulations Title 42, Section 418.1115, SSA calculates your Medicare income-related monthly adjustment amount, the IRMAA surcharge, using your tax return from 2 years prior. Your 2026 Medicare premiums are determined by your 2024 modified adjusted gross income. Your 2027 premiums by your 2025 MAGI. For 2026, CMS published IRMAA brackets in October 2025. For joint filers, the standard Part B premium of $185 per month applies up to a 2024 MAGI of $212,000. From $212,000 to $266,000, Part B rises by $74 per month per spouse, and Part D rises by about $13.70. The brackets continue upward in equivalent steps, reaching over $440 in extra Part B charges per month at the highest tier. Margaret turned 65 in April of 2026. Dennis was already on Medicare. Their 2024 MAGI of $227,000 placed them in IRMAA Tier 1. The surcharge, approximately $87 per month per spouse, times 2 spouses, times 12 months. About $2,100 in extra Medicare costs in 2026 alone. And IRMAA will continue at that tier until SSA reassesses on a future, lower MAGI year. What makes this trap so cruel is the timing. Margaret claimed in June of 2023. The IRMAA penalty hit in 2026, 3 years later. When the Medicare letter arrives, most retirees have no idea what is being measured. The connection back to the 2023 decision is invisible. Add it all together. Approximately $31,380 in withheld 2023 Social Security benefits. Approximately $2,600 in federal income tax on the taxable portion of her ongoing benefits because her provisional income is permanently above the cliff. And approximately $2,100 per year in IRMAA surcharges for 2026, which will likely repeat into 2027 if her income stays elevated. Total, about $36,000 in real money damage from one timing decision and one severance package that her HR team paid out 2 weeks earlier than they had to. What Margaret should have done, and what you can do if you are watching this in the years before you claim. 5 moves to close the trap before you file. Move 1. Map your earnings cliff before you claim. List every taxable event in the year you plan to claim. Severance, deferred comp, vested stock units, large Roth conversions, business sales, bonus payouts. If any push you over the earnings test limit and you are under full retirement age, do not claim that year. Wait for a clean year. Move 2. Use full retirement age as the hard line. The earnings test disappears the month you reach full retirement age. For workers born in 1960 or later, that is age 67. Move 3. Run the 8% calculus. Every year you delay past FRA up to age 70 adds 8% to your monthly benefit. Codified in Title 42, Section 402W. Credits stop at age 70. Waiting from 67 to 70 means 24% larger checks for life, permanent, and adjusted upward each year by the cost of living adjustment. Move 4. Coordinate with the IRMAA 2-year lookback. 2 years before you turn 65, watch your modified adjusted gross income like a hawk. The return you file that year sets your Medicare surcharge for the year you start Medicare. A Roth conversion in the wrong year, a one-time RSU vesting, even a large capital gain, any can cost you $2,000 to $5,000 in IRMAA. The fix is timing. Push large taxable events outside the IRMAA look-back window. Move 5. Get a Social Security claim analysis from someone who is not selling you anything. SSA local offices will calculate benefits at multiple claiming ages for free. Fee-only fiduciary planners through NAPFA will run claim strategy projections at no commission. Volunteer counselors at the National Council on Aging will do the same. The one person you should not rely on is the insurance broker who profits from rolling over your 401k. Margaret cannot undo what happened. The $31,380 in 2023 withholdings is gone in present value terms. The 2024 MAGI spike is locked in for 2026 IRMAA. The 85% taxability is locked in as long as her provisional income stays elevated. What she can do, and what her advisor finally suggested in 2025, is appeal her IRMAA surcharge using Form SSA 44, documenting the work stoppage as a life-changing event. That brought her 2026 Medicare premium back to the standard tier, saving about $2,100. She also pushed her remaining 401k and Roth conversion activity into 2025 and beyond, outside the IRMAA look-back window. The lesson for everyone watching: Your Social Security claim is not a one-time form. It is a year-long decision about every other dollar of income that flows through your tax return. The year you claim sets the pattern for your next decade. Pick the wrong year and 3 penalties stack. Pick the right year and you keep every dollar of the benefit you spent 40 years earning. If you found this useful, hit the subscribe button and share this video with someone who is about to claim. The earnings test, the 85% taxability cliff, and the IRMAA 2-year lookback are the 3 rules SSA, IRS, and CMS will never put into a single letter for you. So I am going to keep putting them in the same video. In the comments, tell me your age and the year you are planning to claim. I read every one, and I will tell you which of the 3 traps is the biggest risk in your specific situation. I will see you in the next video.